Great. Welcome back to Generational Gains with Carson Herlean, my son, my oldest, and myself, Greg Herlean. And today we are going to dive deeper into infinite banking policy, IBC, concept, I should say. And this is a lot more a Carson subject, but in general, it is our combined subject about taking back control of your money. We're going to focus primarily on kind of getting deeper, I think, in this episode, but also the future episodes in the specifics of what we're seeing, what works, what doesn't work. But we're just going to dive deep into our two subjects of self-directing, but also IBC and insurance policies. And that's partly because that's the feedback we've been getting from others is, hey, let's dive deeper into the subject matter that you spend all day and night on, frankly. And so that's what we're going to do. And I think through our experience, the whole generational gains thing is my experience in the business world combined with hearing also Carson's experience in the business world, building his business. But the common thread that we have is being the bank and unlocking your money. Yeah. And when I say being the bank, it means a lot of different things we'll talk about, but unlocking your money from all perspectives, not only from other institutions and banks, which is kind of what you talk about, but also from retirement accounts and brokerage accounts in the traditional stock market world. So what today we're going to focus a little bit more on the IBC stuff and the policies and the ins and outs of that and answer some questions that we've been getting this week. And I think a lot of our podcast in the future as well is going to come back from a lot of questions and feedback that not only are we getting in our office or with our staff, but also from our messages and from social media. So if you have questions or if you think of something or you want us to cover on these subjects, look, I would say Carson is an expert in this space. He's done it now enough times, so many policies, and talked to so many people that he's an expert in the space, as I am with self-directing. So anyways, to jump into the IBC stuff, why don't we take one step back, because there is some new people listening that might not have heard a prior podcast where you talked about IBC and what it is. I won't say your elevator pitch, because I think it's almost nearly impossible to do an elevator unless it's like maybe 200 stories up, maybe like in Dubai. But like, what's your pitch or explanation in general of what an IBC policy is for probably the new listeners, real quick, before we jump into the deeper stuff?
Yeah. So infinite banking is a 200-year-old strategy used by some of the wealthiest families in America that they've used to build wealth with. And not just, one generation's worth of wealth, but multiple generations worth of wealth through this concept. And it's not super crazy. It is pretty simple when you get down to it. All we're doing is looking at where our money's flowing. Because right now you have income that comes in. You work every day, income comes in and it goes where? Right? It has to flow somewhere. And then once it's in that place you keep your funds, it then gets sent out. You spend it on things today, or you save it and spend it in the future. Your money does that. That's really it. Right? So the whole idea of infinite banking is adding one step to where your money goes. It's going through a specially designed whole life insurance policy as in a middle account of where your funds go before it goes out to those things you spend money on. And I say whole life insurance, and a lot of people think, oh, it's the life insurance that my broke brother-in-law sold me, or that my insurance agent down the street can get me. But it's not that. It has to be very specifically designed to do this concept. So you can't get this anywhere. But you'd get a specially designed whole life policy that looks more like a supercharged bank account than a life insurance policy itself. It's liquid, it's guaranteed to grow, you can access it, and it does have a death benefit, so it is life insurance. But we use this account as a middle place of where our funds go before we make big purchases like cars, homes, investments. Our money flows through the policy. And so I guess the main reason we do it is over 10, 15, 20, 30 years, your money is going to be much more efficient and be growing a lot more because you were running it through a policy that was compounding for you first while you were using your money at the same time.
Perfect. I think that was probably one of the best explanations I've ever heard you share, probably because you've done it now thousands of times.
Yeah.
And so I want to just talk about, and you explain specifically designed. because I feel like that is the special sauce. Look, I was life insurance licensed when I was your age, not
Yeah.
anymore.
Yeah.
And I sold term and universal life.
Yeah.
And that's what I sold.
Yeah.
And that's, you said specifically designed. Can you kind of, let's like just dive into that now? Like what does that mean for an individual when you say, I'm going to do a specifically designed whole life insurance policy for you?
Yeah. So life insurance is basically a payment for a death benefit. All right, that's what life insurance is for. Now, there are some types of life insurance that have cash value, which is basically an amount of money the insurance company says you can have access to while you have the policy. And if you take that money out, it's going to be as a loan against your dollars you put in and against your death benefit. So it's like a 401k. You put money in, you can access it via a loan, take money out, and your 401k dollars are still there. Same kind of idea. Or another example, you have a mortgage. You make a mortgage payment, you get equity, you take a HELOC. You get a loan against your asset. Same kind of idea. You deposit money in your life insurance, you take a loan against the asset. And so now we can build a policy where usually life insurance, you put dollars in for years and you don't have any cash value for 5, 10, or 15 years even.
Well, and that's because, and God, please correct me if I'm wrong, but that's because typical life insurance is that people don't buy it for the purpose you said. They buy it for the purpose of just for death, not life living insurance. They buy it so if they typical question is if I can put up $100 a month or $1,000 a month, how much the max amount of death benefit I can get?
Yeah,
and that's typical life insurance. Right?
Correct. Yeah, and that's a good point. I mean, so when you're building a policy to do banking, well, you're not going to have a massive death benefit.
It's almost the opposite.
It's almost the opposite. You have access to more money today and less of a death benefit. And so you do have to understand that's the kind of policy you're getting. If you expect to have millions of dollars of a death benefit, probably not going to happen with this type of policy. But again, we're building it to be specially designed to have more money available day one. Instead of waiting 10 years to have access to a lot of money, it's right away you can start accessing the funds. And now you still get to put money in the life insurance environment, which is a great environment to be for your money, but you also have liquidity, which is why these policies are impactful for purchases and financing.
Which I think is also unique, is coming from, I sold this 23 years ago for like 3 years. So I understood just enough, right? Still today. But most insurance policies, because it's for the death benefit, the availability of the cash to pull out is almost zero or none. You put up $10,000 on a premium and there's maybe $500 available to pull out. These policies, which is I think the most unique thing, which is why most life insurance agents maybe get a bad rep, but also don't know what they're talking about.
Yeah.
Is they will say, oh, I can do that. Oh, IBC, I got it. I'll put it in a universal life policy or whatever. And they want you to do a big premium for a decent sized death benefit, but then you don't have access to majority of your cash. These ones pay way less commission. And the reason for that is because there's so much availability for every dollar you put in. It's on average, what do you have availability? 90% on average, give or take, sometimes more, sometimes a little less, of every dollar you put in that you can take out in a loan.
And that's just the first year. Every year you have access to more and more money. If you have a policy that's probably 10 years old, I guarantee you, if you actually looked at the illustration, your premium dollars that you put in, your cash value probably grew by 50% more, 100% more than what you put in, tax-free. So your policy is growing by a lot long term because it's compounding on everything you've put in over the years.
So I'll pause for 1 second and just say this. This subject, Carson just probably explained it the best that almost anyone can explain it, but it's also specifically designed for you as an individual, for me as an individual. So what I'll say with this, and I think you always say, is if you want to and this is the sales pitch. There is no sales pitch, by the way, but this would be it. Is if you want to see how this even works for you, or have lots of questions about it, in particular for your case, like, oh, this might not work because I'm sick or whatever the case is, do a call. Like, do a call with Carson. And what I say when people want to work with me is like, look, or don't want to work with me, well, I'm going to give you as much contact as I can, knowledge. And I think Carson's learned that at a way earlier age than me. He's going to tell you how it works. And if you decide that you want to work with him and his team, cool. But that's our goal, is to educate you. And so when you go and make a decision on creating your own bank account using a whole life policy, you've got all the tools. And so if you want to take all the information, you might hate this, from Carson, then hey, look, brother-in-law or sister-in-law, I want you to do this policy for me. So be it. Go for it. I don't know that they can match it, but that's okay. The whole point here is if you've got questions and you want to know, contact us, contact Carson, send him a message saying, hey, I want to see if this works for me. So I wanted to put a little plug in for you because you probably aren't going to do it, but people want to know how this applies to them in particular. And so, all right, so the question that I have for you that I think a lot of people ask is how much does somebody need to start with to start a policy, one of these banking policies with you? Like how do I know what I should start with? How would somebody know what to start with?
Yeah, and I wouldn't say there's a magic number. There's not like a one size fits all. I mean, the policy just kind of fits right into your situation to like, hey, I save X amount of dollars every month that I just put aside for my taxes every year, or for when I make investments in a few years. Like, well, why don't you just store those funds in your policy instead of in a bank account? Easy enough. Most people put aside $500 a month, $1,000 a month. That's where you should start. Just start changing and redirecting where your money is stored.
But couldn't you, let's say that my expenses every month are $10,000.
Yeah.
My mortgage or rent and utilities and car, let's just say it's $10,000 a month. And let's say I make, I don't know, $13,000 a month.
Yeah.
Couldn't I do a policy, or would it to really make it advantageous, do a policy where I do $10,000 a month into this, or maybe $10,000 a month into it every month, and then pull out 9 and pay expenses, and then rinse and repeat, and then just keep putting in the next 10 every month and pulling out 9 for expenses? Or is that not how it works? Is it more meant for loans that you pull the money out for, like a car, and then you pay that back in payments? Does either one work, or is it just?
Yeah, no, I get your question. So remember, whatever you take out of your policy, it's coming out as a loan. Like your house. If you're going to get a HELOC against your house, why would you get a HELOC against your house? Well, you probably have a big investment that's going to return well. You're going to take it out for. Maybe you need to buy another rental property for yourself.
So the answer is you wouldn't do that.
You wouldn't do that.
You wouldn't do that. You would do it for something that's going to pay back. So or that you'd have to borrow. So so the perfect example that you always give is the car.
Yep, easy. Everyone needs a car every 4 or 5 years, right? Everyone buys a house every 5-7 years. So 2 easy examples. If you're going to save up $500 a month and then in 5 years drop 30 grand on a car, why would you do that and lose the 30 grand and have that 30 grand sitting somewhere volatile for the next 5 years? And you'll probably dip into it. Might as well put that aside into a policy where it's going to grow at a higher rate than it would in a bank. It's going to be guaranteed to grow no matter what happens in the world or the market. And you can access it whenever you want for the car still.
So he said something that you can't normally say.
Yeah.
He used the word guarantee.
Yeah.
Whole life is one of the few things that you can say the insurance company guarantees to pay at least an X% interest rate. It's written in the contract. It won't be less than, right now, it was
like 3%, somewhere around there. Yeah, most.
It won't do less than that. Now, it can do higher than that.
Yeah.
And does often, especially right now, it does a little higher than that.
Yeah.
But 3%. So the idea is if you can save around $500 or $1,000, let's say I can save $1,000 a month. I'm putting it in a savings account already. And then when something comes up, I use it to buy or whatever.
Yep.
All you're doing is unlocking, using that money rather than putting in a bank account, that $1,000 I put into a whole life policy.
Yep.
Then when I have something to buy, a house or something else or an investment, I take that money out, purchase the investment or the car. And let's say it's a car. And let's say that I was going to buy a $50,000 car, take out $50,000, and that payment, if I were to get a loan at a bank, is going to be $1,000 a month, let's just say. Well, instead, I'll pay the car off, get title to it, so I own it. But now I'll pay that $50,000 that I borrowed back, $1,000 a month, every single month that I was going to pay to the bank anyways. But now I pay it back to my insurance policy. And at the end of 5 years, I'll have a car paid off, which will be paid off from day one, but I'll also have my 50, probably more, $1,000 back in my checking account or my whole life.
100%. And you would have been earning interest in the whole 50 from the first day too. So that's why you said you'll have more access to more, because over 5 years you'll be compounding on that 50K for 5 years. You'll have access to more and have the car paid off.
So I mean, everybody should do this.
Theoretically, yeah.
I mean, so who is there anyone that shouldn't do this or doesn't qualify for this?
I mean, everyone can and probably should do this. The only people that should not do this are those who are not disciplined with their money, live paycheck to paycheck, and don't know how to keep stuff straight. Those people should not be doing this. Other people who should not be doing this are those who I think only thing they want to ever do with their money is put it in a stock market account, no matter what type of account, and they want to just ride the appreciation of the market. If that's the only thing you ever want to do with your money, you probably don't want to go through a policy, because you're not going to have any way to pay yourself back because you're leaving it in the account, and you're probably going to get a better return by putting it there. And so it wouldn't make sense for you to run those things through the policy. If you also have, but that's very difficult to find someone like that, because everyone needs money. Everyone buys cars. Everyone spends money on taxes. Great, you should be running those things through your policy too. So it's very difficult to find those people, but there are those people. And so 90% of Americans could probably do this. They just don't, because they haven't been taught how to do it, or they've been sold the wrong thing. If you go to a financial advisor or an insurance agent, they sell retirement accounts and insurance policies. They don't teach banking. So they're not going to sell you banking policies to do this. So you have to go to very specific people to actually build the system like this. Not many people teach this.
When you have a team, I mean, that's one thing that's great too. Carson's got a whole team, so they that support his clients and his business. And so when you get Carson, you get a whole team that helps you. I know this because I've done it firsthand, right, with Carson so.
Well, last month you got another policy with me.
I did.
How many is that now? Do you have like 6?
I probably have
4 or
8
5
policies.
8 policies.
Yeah.
So that's another question I think a lot of people ask is, why do you have multiple policies? Why did you add more policies?
You told me to. Why'd you tell me to?
Couple reasons. One, you had a new child, a new baby. So of course, the sooner you can get a policy on an individual, the better, because the longer it's going to have to grow. So yeah, getting a policy on a new person in the family is a great idea. And another reason you have multiple policies is if you have more money, you want to keep running through it. Let's say your policy is 10 grand a year you're putting into it. Well, if it's set for that, you probably can't do much more than that because it's set for that amount. So if you're doing that consistently, you have more income, you want to be running through it, you can't overfund the first one, you need a second policy.
So let me just reiterate and restate that one more time if you didn't catch it the first time. A lot of people like this concept and they're like, this is great, this is how I'm going to bank. And they say they can save $1,000 a month.
Mm-hmm.
But then fast forward 6-8 months, they're like, hey, you know what? I can save $2,000 a month.
Yep.
Life insurance isn't totally like your bank account where you can just add whatever dollar amount to it.
Yeah.
And that answers the question of why do I have so many policies? If y'all want to add more to an insurance policy, I've got to start a new life insurance policy. If there's premiums X, I can't really put too much more than X.
Yeah.
Now, the other way works as well. I mean, I believe, why don't you tell me if this is correct, but if I commit to $10,000 a year, and let's just say after 6 months or 16 months, I can't for 3, 6, 12 months, can't do $1,000 a month like I committed to. Is that okay? Does that mess up my policy?
Yeah, even though it is kind of a set amount you're putting into it, you do have flexibility. You can do more than it's set, you can do less than it's set, and you can go pretty far both ways. But the most efficient way to fund it would be to do that amount that you're set for. You can do less if times are slower, 100%. So you have flexibility with that, and that's what a lot of people do is they say, hey, I'm comfortable saving $1,000 a month. So let's just start there. And then they take some loans out of the policy, they pay off some credit cards, they pay off a car they're paying $500 a month for. They now understand investing, they do an investment here, bringing in another $500 a month. And now they're like, well, okay, well, I have a lot more money now freed up each month. I should be flowing through my policy. So that's when they go and get a second policy, just like you have and just like I have. So that's a great way to go about it.
So what are a couple top questions? I mean, you take on calls from clients all day, every day. What are some of the top couple questions that you get that people ask you?
I think a lot of people come into this and they think it's too good to be true because they're like, I've never heard of this and I saw on Instagram, so how do I know this is real?
Yeah.
And it's like, well, okay. Or the same kind of idea where it's like, what's the risk? What's the catch? Well, this policy you're getting, like you said, is guaranteed. It is a legal contract you have with an insurance company. They can never go away from it. So you are guaranteed to grow your money every year of your life. You're guaranteed to have a tax-free death benefit. You're guaranteed to have liquidity. Like, it is the most riskless product in probably the country. It's backed by the strongest financial institutions in the country. So there's no risk in the policy specifically, but the risk or the catch is, well, how you use it. You could take loans out, do stupid things with it, lose the money, not be able to pay yourself back, and the policy lapses. Like, you could screw the system up. So when the people are talking about, hey, this is too good to be true, or how do I do this? What's the risk? Like, well, the policy's pretty safe. Like, there's not much you can go wrong with it. It's just how you use it can get in the way. And that's why you want to work with someone who teaches you how to use it and not just sells you the product like an insurance agent would, but showing you how to use it.
And I think that's an important thing that he just brought up, because I was sold on this product, this whole life policy, years before Carson actually started getting involved in it and selling it and using it himself. And then he asked me one day, he's like, hey, so do you use your policy? I'm like, well, no, not really. He's like, you don't use it? You don't like take money out of it? I'm like, no, I just look at, I put money into it. I just never take money out. He's like, it a little bit defeats the purpose of creating this bank.
Yeah.
You should be doing that and moving it like we just talked about. And so I would say that's one big takeaway I got when Carson started in this, is he asked me about my policies and I wasn't using them how you're supposed to. And so you definitely should be using these policies. And that's something your team does really well as they follow up with, like, do you need help? Do you understand how to pull out the money, how to pay back the money? And those little things are important. I think that was partly, just being honest, one of the things I was, I'm a little bit old school, but the work associated with pulling the money out and putting it back seemed daunting to me. Like, I don't know if it's
a lot of work.
It's work.
Yeah.
But it's once you do it a couple times, it's just like getting money from your checking account.
Yeah.
Or getting a wire. Maybe not a checking account, but like a wire where it takes like a few minutes. But a lot of these things are slick. They're online. You can request the money, and then you can pay it back via auto draft, which is what I do on mine. So every time I take a loan out, I immediately send in the paperwork to increase or to create a auto pay. So if I borrow $100,000, immediately thereafter, like that next month, I tell them to start pulling $2,500 out of my bank account to pay back that loan. And that's just something that I've been doing, every time I take a loan now. And so I use the funds.
And then every 3 or 4 months, you probably look back at the accounts and you're like, oh, it filled back up again.
Now there's cash.
Let's go do another investment.
Yeah.
Like,
now there's cash in there again. So it definitely works. It's a proven model, like he said. And one thing I was going to mention too is, how many life insurance companies are you familiar with that have failed?
Mutually owned insurance companies, not a ton. A couple have gone bankrupt in the past 20 years, but like the main companies I work with have been around for 130 years, like longer than the tax code was even around, longer than the IRS, longer than some of the S&P 500 companies. Like, it's one of the strongest places.
Well, and I'll piggyback that. There's way more banking organizations and banks that have gone under.
Oh yeah.
Than insurance companies.
Like
more than tenfold. I don't know what the number is, but it's we're in the hundreds, not in the handful of insurance companies. And so insurance companies are typically where the government and banks go to borrow money.
Yep.
They are the most stable institutions in this country.
Banks are actually the #1 purchasers of these type of whole life insurance policies. They buy more in whole life insurance than land and buildings combined. And when Joe Biden actually talking about other individuals who do this, when he became president 4 years ago, his tax returns became public, and he had 4 whole life insurance policies built like this on his tax return. No matter what you follow in politics, like, he's a wealthy person, wealthy family, he's doing this too. Like, the banks are doing this, the government's doing this, politicians do this. Like, why isn't this something that everyone's taught to do?
That's good. Well, good guys. This is helpful. Is there anything else? Any last things that you want to add, or the commonly asked questions before we wrap up today's episode?
I just had a funny thought, maybe not education or advice here, but I was thinking about banks, like you said, and I was thinking about how they're all FDIC insured, right? And how everyone has so much faith that your account's FDIC insured. I'm gonna get 250K no matter what happens with the world, but it's like it's backed by the government, the U.S. government, and the U.S. government is in over $30 trillion worth of debt. So is that where you want to be collateralized by, is someone who's in $30 trillion of debt? Like, who cares if it's FDIC insured? That's just more debt they're gonna owe. It doesn't. They have no real collateral to back bank accounts. I don't know why they FDIC insured is even cared about. Like, that's why whole life insurance and these insurance companies are so safe. It's not FDIC insured. That's great. That's a good thing. It's not backed by the government. That's a good thing. The government actually puts their money here.
It's a false sense of security, and it's been around so long that it's what's used and what people say, and it gives people comfort. But to your point, I'd rather have a contract with an A-rated insurance carrier that says I'm guaranteed to make X that I can get my money from than a bank that has $250,000 FDIC. I don't disagree with you on that.
Like, even during COVID, I remember someone in our office tried to pull like 20 grand out of their bank account. They wouldn't let him do it. He went to the insurance company. They gave it to him in like a day, wired right to him. And I was like, that's crazy. Like, it's really interesting.
Yeah, it is. That's good.
So I don't know. Interesting thought to finish with.
That's good. Well, look, hopefully today was good. I really enjoyed this. You're going to see a lot more episodes us diving deep into questions. Carson's going to pay attention. So am I. The social media questions that we get, also clients' questions that come in, and we're going to focus, our energy on that, help answering questions so you can understand how to unlock your money, drive it, deeper, and create more wealth, generational wealth and personal wealth by being the bank. And so that being said, let's just end on maybe a suite that we had. Let's just do a suite today that you might have had in the last 24, 48 hours. Any suite you want to share?
I've actually really enjoyed watching the Olympics lately. I put it on the TV all day in the background while I'm working, and I just watch volleyball, swimming, basketball. It's been so fun. So I've really enjoyed that, actually.
That's a good suite.
Yeah.
I would say my suite has been seeing the rotation this summer of my kids all coming by the house and surfing, then swimming, then ping pong, then eating, then repeat over and over again. That's been my suite. Seeing it almost every single day. The floors have been sandy. I've been doing a lot of sweeping of the floors every night and every morning, but I wouldn't have it any other way. So
that's what you get for living by the beach.
I do. Anyway, so thanks for listening in today, and look forward to doing our next one.
Thanks, guys.